Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hyatt Hotels Corporation Annual Report. Hyatt Hotels Corporation offers a diverse range of businesses and services to cater to various customer segments. The company operates through multiple segments, including owned and leased hotels, Americas Management and Franchising, ASBAC Management and Franchising, EAME Management and Franchising, and Apple Leisure Group. Under these segments, Hyatt manages, franchises, licenses, owns, and leases a portfolio of properties that include full-service hotels and resorts, select service hotels, timeshare, fractional, residential, vacation, and condominium units. The company operates its properties under various brand names such as Park Hyatt, Alila, Murrevel, Andes, Thompson Hotels, and many others. In addition to hotel operations, Hyatt also offers a short-term vacation rental platform called Homes and Hideaways by World of Hyatt, which features direct booking for short-term private home rentals in the United States. The company also provides distribution and destination management services. Hyatt serves various customer segments, including corporations, associations, specialty market accounts, travel agencies, luxury organizations, and individual consumers through its loyalty program, World of Hyatt. This program rewards points that can be redeemed for hotel nights and other rewards. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of Hyatt Hotels Corp. Has increased slightly over the past year due to several factors. One major reason is the company's efforts to expand its global presence through strategic acquisitions and partnerships. By increasing its portfolio of hotels and resorts, Hyatt has been able to tap into new markets and attract a wider range of customers. Another factor contributing to the increase in stock price is the company's focus on digital transformation. Hyatt has invested heavily in technology to enhance the guest experience, improve operational efficiency, and drive revenue growth. This includes the development of mobile apps, online platforms, and data analytics tools that enable guests to book rooms, access services, and provide feedback. Additionally, the hospitality industry as a whole has experienced a resurgence in recent years, driven by growing demand for travel and tourism. As one of the leading players in this sector, Hyatt's stock price has benefited from the overall trend towards increased spending on leisure activities. Finally, the company's commitment to sustainability and social responsibility has also contributed to its positive reputation and financial performance. By prioritizing environmental stewardship, community engagement, and employee well-being, Hyatt has been able to attract customers who share these values and are willing to pay a premium for their stays. Overall, the combination of strategic expansion, digital transformation, industry growth, and corporate social responsibility have all contributed to the slight increase in Hyatt Hotels Corp.'s stock price over the past year. Hyatt Hotels Corporation maintains a market capitalization of $16 billion, broadly in line with the industry peer group. Hyatt Hotels Corporation trades at a lower price-to-book ratio of 4.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for Hyatt Hotels Corporation can be identified by examining the company's financial statements. According to the income statement, revenue for the year ended December 31, 2025, was $7.1 billion, indicating a significant increase from previous years. A closer look at the income statement reveals that operating expenses were $4.9 billion, which is a substantial portion of total revenue. This suggests that cost management and efficiency are crucial factors in driving revenue growth or decline for Hyatt Hotels Corporation. The company's ability to manage its costs effectively will have a direct impact on its profitability. In addition to cost management, the company's investments in property, plant, and equipment, as well as intangible assets, may also be contributing factors to revenue growth or decline. These significant investments can provide long-term benefits, such as increased capacity and improved efficiency, but they also come with upfront costs that must be carefully managed. Overall, Hyatt Hotels Corporation's revenue growth or decline will depend on its ability to effectively manage costs, invest in strategic assets, and adapt to changing market conditions. The net income of Hyatt Hotels Corporation experienced significant fluctuations between 2024 and 2025. On page 26, the company reported a decrease in net income due to various risks and liabilities, including investments in owned and leased real estate, potential failure to repay or refinance loans, and cyber risk. This led to a decline in profit margins caused by increased costs from compliance with applicable laws and regulations. On page 28, the company attributed the decrease in net income to a decline in consumer demand caused by global economic conditions, health and safety concerns, and travel restrictions. The reduced revenue was not offset by sufficient cost-cutting efforts, resulting in lower profit margins. Additionally, on page 82, the company reported a significant decrease in net income of $1,348 million, minus 104%, from 2024 to 2025. The effective tax rate increased by 144.3% from 17.1% in 2024 to 161.4% in 2025, contributing to the decline in net income. The adjusted EBITDA margin decreased slightly from 96% to 95.8%. On page 94, the company reported a change from net gains of $3 million in 2024 to net losses of $10 million in 2025. Overall, the changes in net income and profit margins were largely driven by external factors such as global economic conditions, consumer demand, and regulatory compliance costs. The company's inability to offset revenue declines with sufficient cost-cutting efforts also contributed to the decline in profit margins. The company's operating cash flow is a mixed bag. On one hand, there are instances where it is generating positive operating cash flow, such as in 2024, when it reported $96 million in positive operating cash flow. However, this is not consistent across all years, with the company reporting a negative operating cash flow of minus $227 million in 2025. Despite these fluctuations, one statement stands out as a clear and direct answer: operating cash flow. Yes, on page 79. This suggests that at some point, the company was indeed generating positive operating cash flow. However, it is unclear if this is a consistent trend or an isolated incident. The company's debt level and interest expenses have undergone significant changes in recent years. An examination of the data reveals that the total debt has increased by 12.6% from $3,782 million to $4,278 million. This increase is attributed to a combination of factors, including an additional $1,700 million borrowed on the DTTL facility and the repayment of $1,700 million of borrowings on the same facility. In terms of interest expenses, there has been a notable increase of $137 million from 2024 to 2025. Furthermore, it is stated that interest expenses have increased significantly, indicating a substantial rise in the company's financial obligations. These changes suggest that the company is shouldering a greater burden of debt and associated interest costs, which may impact its overall financial performance and stability. The performance of various segments and regions within the company has been mixed. On a positive note, the upscale segment has shown strong results, driven by leisure and business guests, extended stay visitors, and meetings. The United States has also performed exceptionally well, accounting for 69.8% of total revenues in 2025 and 75.8% in 2024. The management and franchising segment has seen an increase in revenue and adjusted EBITDA, with a notable improvement in the distribution segment. However, other segments have struggled. The upper mid-scale segment has underperformed, particularly in terms of extended stay guests and leisure and business activities. The Americas, excluding the United States, Asia Pacific, excluding Greater China, and Middle East and Africa regions have also shown poor performance. The owned and leased segment has seen a significant increase in revenue, but this has not translated to improved adjusted EBITDA. Furthermore, the management and franchising segment's expenses have been substantial, resulting in lower than expected adjusted EBITDA. These underperforming segments will require attention from the company to improve their results. Management's outlook for Hyatt Hotels Corporation is cautiously optimistic, as reflected in the company's financial performance. The significant assets and revenue generated in 2025 indicate a strong foundation for growth. However, the substantial debt obligations and cash used in financing activities suggest that the company is actively managing its finances to maintain stability. The management strategy appears to focus on balancing short-term financial needs with long-term goals. The repayment of senior notes at maturity and the entry into a new credit agreement demonstrate a commitment to managing debt and maintaining liquidity. Additionally, the recognition of stock-based compensation expense as a non-cash item suggests that the company is investing in its employees and future growth. The segment and geographic information highlights the company's diversified business model with 3 reportable segments: management and franchising, owned and leased, and distribution. This diversification likely contributes to the company's resilience and ability to adapt to changing market conditions. Overall, management's outlook suggests a focus on financial prudence, strategic growth, and long-term sustainability. The company has made several acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased Playa Hotels, Standard International, Alua Portfolio, Me and All Hotels brand name, and Bahia Principe transaction in 2024. Additionally, it acquired UVC transaction with no specific details provided. The acquisition of Alua Portfolio also included €38 million in interest rate swaps assumed by the company. In terms of divestitures, the company has sold several properties, including Hyatt Regency Orlando, Park Hyatt Zurich, and others in 2024. It also sold an 80% stake in its Unlimited Vacation Club paid membership program business in 2024. Furthermore, the company plans to sell Alua Atlantico Golf Resort, Alua Tenerife, and Alua Sol Orotava Valley in 2025. The sale of shares of entities that own the Alua portfolio was also completed in 2024, with the buyer assuming interest rate swaps previously held by the company. The company has demonstrated a commitment to returning value to its shareholders through 2 key initiatives. Firstly, the company has paid dividends on a regular quarterly basis, providing a steady stream of income to investors. This indicates that the company is generating sufficient profits to distribute a portion of them back to its owners. In addition to paying dividends, the company has also engaged in share buybacks, purchasing 10 million shares for $1.48 billion. This strategic move aims to increase shareholder value by reducing the number of outstanding shares and thereby increasing earnings per share. By doing so, the company is signaling confidence in its future prospects and a desire to reward its shareholders with increased returns on investment. Concerns about inventory buildup or supply chain disruption are evident in several pages of the extracted summaries. On page 1, general economic uncertainty and global supply chain constraints are mentioned as potential issues. Additionally, rising costs of construction-related labor and materials due to inflation or other factors may not be fully offset by increases in revenues. On page 17, potential supply chain disruptions are highlighted due to bookings through internet travel intermediaries or online travel service providers. Labor shortages on page 25 could also restrict the ability to operate properties, further exacerbating supply chain issues. Global supply chain constraints and interruptions are mentioned again on page 27, emphasizing the ongoing concerns about supply chain reliability. Furthermore, pages 30 highlights potential risks associated with loss of distributors, increased distribution costs, or unfavorable renewal terms for agreements. These concerns suggest that inventory buildup or supply chain disruption may be significant challenges facing businesses in this industry. That concludes the financial summary for Hyatt Hotels Corporation. Feel free to comment below, and I will be happy to answer them when possible.